February 6th for the Police and Fire Retirement Plan and Healthcare Trust meeting. Roll call. Myself, Andrew Gardner is present. Vice Chair Drew Lanza is present. We do have a new trustee that's going to be replacing Gia that was in front of City Council this week. He will not be here today, but he will be starting next month. So he's absent today. Trustee Menon is here. Trustee Mule is here. Trustee Oswald is not here at the moment, but we do anticipate him. Trustee Santos is present. Trustee Sanseri present, and Trustee Votto is present. We also have our CEO, Roberto Pena. We got Council Leaderman here, CIO, Prabhu Palani, and staff. Thank you for everybody being here. So at this moment, we're just going to go ahead and go to closed session, and we'll be back shortly. Let's go ahead and get started. We're back from closed session. Orders of the day, there are, there's nothing to report out from closed session. Orders of the day, there are none, but just a reminder, please, when you're speaking, speak into the mic. And then I'll make sure that when we do any votes that I'll call out who's making the motions and second. Consent calendar. Is there anything on the consent calendar that you guys would like to pull for discussion?
Motion to approve.
Motion by Santos to approve.
Second.
Second by Nick. All in favor?
Aye.
Aye. All right, on to section 2, investments. Oral update from our CIO.
Thank you, Mr. Chairman. I have a few updates. We have the flash reports for December. And as of December 31st, the pension for the calendar year 2019 actually returned 13.8% versus a benchmark of 13.3. And of course, fiscal year is more important for us, and that's from July 1st, 2019 to December 31st, 2019. The plan returned 5.1% versus a benchmark of 5.4%. And healthcare, calendar year 2019, the healthcare trust returned 16.9% versus a policy benchmark return of 17.1. And fiscal year to date, that is July 1st, 2019 to December 31st, 2019, the healthcare trust returned 5.7% versus policy benchmark of 5.4%. These are, of course, flash reports. They're not final numbers, but they should be close to the final numbers. And a couple of other updates. We have issued an RFP for custodian and, for our investment consultant. The deadline for that is February 21st, 2020. And I will be working with both IC chairs of both boards and the investment team in making recommendations to the boards. We will first discuss it at the May IC, and hopefully we will bring a recommendation to the June board meeting. The custodian RFP has been completed. We are actually doing some on-site due diligence now. And our recommendations will be brought to the IC in March and to the full board in April. And March 5th, at our next board meeting, we will be conducting an ESG study session with some outside speakers. And I'll give you an update on that before the next board meeting. It should last about an hour or so. And finally, asset allocation. I think Ms. Makita has completed its capital market assumption study, and we will be doing some work on that, bringing it to the March IC and hopefully to the April board meeting for the board's consideration. And that concludes my comments. Happy to take any questions.
Thanks, Prabhu. Any questions for anybody? All right, well, thank you. Let's go ahead and move to old business. 3A, discussion action on other post-employment benefits, OPEB evaluation. Good morning, Bill.
Good morning. So we have the final results of the 2019 valuation for the OPEB plan. Just as a reminder, there are two parts of the benefit for this plan. There's an explicit premium subsidy, and then there's an implicit subsidy for the difference in healthcare costs for retirees versus actives. The trust that this board manages is responsible for funding the explicit subsidy. And so in our presentation, we're just going to talk about the explicit subsidy. The valuation develops the city's contribution for fiscal year end 2021. Member contributions are fixed at 8%, regardless of anything else. They're fixed in the statute now. We also use this valuation for the accounting disclosures at the end of this year. This is our normal tank diagram split between the police and the fire plans. On the OPEB side, we really have distinct sub-trusts for police and fire, and so they operate as two separate plans. We also have an account in the pension plan called a 401H account. And so the employee contributions go into the 401H account, and the city's contributions go into the 115 trust. Currently, all benefits are being paid out of the 401H account, and so those benefits are larger than the contributions going in on that side, so the 401H accounts are gradually declining over time. Both police and fire started funding relatively recently, so from a near 0%, and so they're both, their funding percentages are a lot lower than in the pension plan, but the liabilities are also a lot lower. So these total dollar amounts are significantly less than what you're seeing in the pension plan. The results in terms of the contributions on the left-hand side are the police, and on the right-hand side, the fire. In both cases, you'll see slight increases in the city contribution, slight decreases in the member contribution amounts. The member contribution amounts are going down because the contributing members are a closed group, and so as they retire, we have fewer members contributing. These are pretty close to what we expected from last year's valuation, and so there's not a ton of change going on here. The red line represents the normal cost, or the expected cost of the benefits for the current year of service. You will notice that the member contributions are higher than that. And so that means all of the city's contributions are going to pay off the unfunded liability. They're not going towards the new benefits. The blue line at the top is the Treadwater. It's the normal cost plus the interest on the unfunded. So contributions up to that point are just paying for the interest on the unfunded liability. And you can see last year we were slightly below that Treadwater. For 2021, the contribution rates are moving up to about equal to the Treadwater mark. And as we go forward from here, we expect them to exceed the Treadwater mark. Similar to the prior slide, on the left we have police, and on the right we have fire. We're focusing on funded status. The bars represent the liability. The blue bars are for the members currently in pay status, so people receiving benefits, and the red bars are for the active members. The police plan is now 32.5% funded, the fire 27% funded. Those funded percentages are moving up, but you can see there's a significant ways to go, and even to just cover the liability for people already receiving benefits. Here, we're just putting those charts into table form so that you can see the numbers and the changes from the prior year. You can see the liability for the police actives actually went down, but for the fire actives, it's still going up. That just has to do with the turnover in the members who are still covered by the benefits. The in-pay status liability went up, but I'll show you on the next slide, it didn't go up as much as we expected. And so we did have some gains there also combining that with the contributions, the unfunded liability has decreased, and the funded ratios have increased. Combined, the unfunded liabilities decreased about 12 million. The contributions were about 1.8 million short of the Treadwater, so that increased it. Our investment experience was below expected. That increased it by about 4 million. Premiums did not go up as much as we expected, primarily for the Medicare eligible. The pre-Medicare premiums went up just about what we expected, but the Medicare eligibles were quite a bit below what we expected. And so that gave us a gain of about 12 million.
And why was that, Bill?
Why? That's been something we've seen across the board, across all plans. The Medicare eligible cost increases have been much more contained. I don't personally know what's actually driving that, but you can also see that in the Medicare trustees report. Their costs have been lower than expected. The other experience that shows a $14.5 million gain, that's a lot of that has to do with fewer retirees covering dependents or covering fewer dependents. And so that has reduced our costs somewhat. We haven't looked into exactly why we're getting that experience. It may be that they have coverage elsewhere that they can get for the dependents. But that's something we'll be watching going forward because that's kind of a new trend, a new item. And then we had some assumption changes, primarily from the demographic experience study that increased our costs. All in all, about a $12 million reduction in the liability. Then if you look at the projections, this is the police projections. We're currently about 33% funded, looking to reach 100% by 2043. So it's a ways out there. I think the other thing to note in that top chart, where the gray bars are the liability and the green lines the assets, is you can see that the liability itself peaks around 2034. And that's because we have a largely closed plan. It is open for catastrophic disability benefits, but that's a much smaller liability. And so that's when we start seeing the turn on the payout of the liability. The bottom chart shows the projected contributions. The purple bars are the members' contributions, and you can see those declining as the population of contributing members declines. And then the gold bars are the city's contributions. And just a reminder of putting this in perspective. That's 15 million for the city compared to combining police and fire and the pension. It's 206 million. So we're really talking about a much smaller obligation here. Oh, and let me also point out the red line, the city has an option to limit the contribution to 11% of pay. Last year, we were slightly below that. This year, we're a little bit more below the 11% limit for the optional cap. So that red line applies it to just the police, and then on this chart for the fire. Our understanding is that it's actually applied in aggregate. So the combination of the two would have to exceed 11% of pay for the combined payroll. The pattern for fire is very similar to police of what we expect in both of these charts. The fire plan is slightly more poorly funded to start with. It's at 27%, and so its contributions are right at the 11% of pay for the city, and expected to remain right around that 11% of pay, maybe going slightly above it if all assumptions are met. So we do have the model we can play with, but I think the results here are very similar to what they were in prior vals. Not a whole lot of change going forward. We have a plan to pay off the unfunded liabilities for these plans. It's going to take some time, but we're on target. So I'll take any questions.
Thanks, Bill. Vince, go ahead.
Are boards looking at pension and OPEB liabilities and making decisions between the plans of how they look at the funded status? And I guess I'm tying it to the fact that you pointed out that the actual dollar values are considerably smaller on OPEB. And so should more funds be directed to shore up the health of OPEB given its funded status?
So it's a complex question you're asking, really. The one big factor that comes in, boards and sponsors in general have focused more on funding pension plans than on OPEB plans. And I think the biggest reason for that is the pension obligation is much more known, much more certain. On the OPEB side, the cost of healthcare bounces around. It's sometimes goes up quite a bit more than we expect, sometimes not nearly as much as we expect. There's all sorts of healthcare reform proposals out there, and there are changes made to the plan, and we've seen those here where they changed the lowest cost health plan, and that has a significant impact on the liabilities going forward. And so the liability itself is more volatile than on the pension side where it's more certain. And so I think that in most cases has driven a focus more to pension than OPEB. There is getting to be a greater focus on OPEB over time. But I guess we're not looking at these plans running out of money, and what I look at is more the dollar amount of the unfunded compared to the sponsor's ability to pay. And so, and really it goes across both plans. So I don't think there's necessarily a reason to direct more funding to the OPEB plan just because it's 30% funded and the pension is 80. Now, clearly, if the pension's 100% funded, that's different.
Okay.
Any other discussion?
Just a couple of comments or questions. Good morning, Bill.
Good morning.
I will be going to the city council first Tuesday, I think, and early in April to present the evaluations. And so a couple of comments. Am I mistaken, or is this the first presentation that you made to us where you always provide, just like in the pension, police and fire information, but then you provide a combined funded status, you know, and I don't see that here. Also, even though you did provide the differences between the two, you did combine the changes to the UAL combined, and so that presents a problem for me because when I go to city council, if I'm presenting detail and then the changes are combined, and also it would be helpful if I had the combined police and fire, even though we have to tackle that differently for the city council. So it's a convoluted question, but you know what I'm getting at.
Yeah, so so the combined figures are in the report.
In the report, okay.
And so I can help you put together whatever you need for the city council. we've been migrating to treating them more as separate plans because the auditors pointed out that as
Yeah.
we've gone to the 115 trusts
that
that
was-
are
yeah.
separate, that they technically should be treated as separate plans from an audit, from a financial reporting standpoint.
And you're correct, that was
And
an audit
so-
coming every year, and now it was stopped.
And so we've started migrating our reporting that way. We switched the financial reporting part of it to treat them as two separate plans, but we've started migrating this that way for the same reason.
Fair enough, thank you.
And so you point out an inconsistency that's fair that we combined it. That's part of our transition, I guess. We have
That's
not
quite
gotten everything converted over to treat them separately.
Any other questions? If there's no other questions, entertain a motion to approve the final actuarial evaluations for OPEB. Okay, got a motion by Nick, second by Votto. All in favor?
Aye.
Aye. All right. To try and keep the momentum going, if Bill's okay and if the board's okay, wouldn't mind skipping to 4C and D. Or do you need a few minutes to gather your thoughts?
No.
You're good?
I'm good. They should be very quick items.
Okay, let's go ahead.
Don't sell yourself short, you're great.
So we'll go ahead and jump to 4C and D, and then we'll circle back to 4A and B.
So 4C is a letter with our 5-year projections for the city's budgeting purposes. It just takes the information from the pension valuation report and from the OPEB valuation report, provides projections for 5 years in the breakouts requested by the city. So there's really no new information that the board hasn't seen in there. It's just taking it from the pieces you've seen and presenting it for their budgeting purposes. So take any questions.
Yeah. No question, there's no action on this one, it's just a discussion, so if there's no other questions, then we'll just go ahead and jump to 4D.
So 4D is a resolution on the assumptions for actuarial equivalence for 2020. And there was a change in Measure F to the charter that we had wanted to get the actuarial equivalence assumptions updated because they were based on some really old mortality tables and an 8% interest rate. And so the change says that the assumptions are based on the assumptions from the prior year's valuation. And so we already have adopted the assumptions for the prior year's valuation. For actuarial equivalence, we have to use a unisex mortality, and we've traditionally assumed for this plan 95% male, 5% female for members, and then the reverse for beneficiaries.
Bill, can I stop you for a second? Would you be kind enough, for those of us that are not that well-versed in the actuarial science, to explain what the concept is of actuarial equivalence and why is it important that we approve the assumptions?
Yeah, I'll get to the
You get to
approval
that?
of assumptions.
Okay, all right.
The way these assumptions are used is when a member retires, there's the normal form of payment that is used, that all the formulas calculate their benefit, and that's the normal form. But they have options for other forms of payment to go to 100% joint and survivor benefit instead of the automatic spouse's survivor benefit, for example. Those benefits, those optional forms in theory should be of equivalent value. And so these assumptions are used to convert the benefit amount in the normal form to each of the optional forms. So for example, if someone in their normal form might be getting a benefit of $2,000 a month, if you increase the survivor benefit, the equivalent value benefit may start at $1,900 a month, some slightly lower amount. These are the assumptions that go into that calculation to figure it out. And it's good to keep those assumptions current so that it's a current value. Now, why is this coming before the board? There was part of the Measure F change specified all the assumptions you have to use as being based on the valuation, but then also specified that the board had to adopt a resolution adopting those assumptions. So we're here with the resolution for you to adopt to comply with that requirement.
And thank you for the explanation, I appreciate it.
Does anybody have any questions on the resolution? If
I'll
n-
move to approve.
All right, we got a motion by Lanza and a second by Santos. All in favor? Aye. All right. Thank you, Bill.
Thank you.
So we'll go ahead and go ahead and circle back to 4A, oral update from the CEO of Retirement Services.
Thank
Roberto.
you, Mr. Chair. Just a few comments, if you allow me, 2 or 3 minutes. We are working on the annual administrative budget, and we plan to come before you board in your March meeting to present the request for the upcoming fiscal year 2021. All the 1099 are forms indicating the pension benefit payments for 2019 for our retirees were issued last month. We also issued last week a member direct letter to all of our active members for police and fire, providing them the PIN information so that they can sign up to the system and have access to the data and request specific information and estimates and everything else. That has gone very well, and we have received very positive comments. Just also wanted to let you know, as you know, during the pension administration system, our outside consultant that was helping us manage the project, LRWL, was just recently acquired by Seagull. So now they are a part of Seagull Consulting. That became official last month. I also wanted to let you know that a new trustee, and thank you to the City Council, was appointed by the City Council at their meeting on Tuesday. In fact, he actually even attended a fiduciary training at our offices on Monday that Fiduciary Council Harvey Lineman had scheduled for our 3 new trustees from Federated. So Howard, even though he had not been appointed yet, he attended the meeting. He's unfortunately not able to attend your meeting this morning. And I just wanted also to let you know we're still working through some specific issues about conflict of interest, making sure that everything is clear. And if that's on, and even though he was already appointed, we need to clear the hurdle one more time to make sure that he can actually join officially your board for your next meeting. So there are 2 more items, if you allow me. One of them, the last one, is an update on the CalPERS defined benefit plan by Ms. Parkman, who cannot wait to give you the update. But before we get to that, I just wanted to let you know we have encountered some issues, you may recall, with the Anthem healthcare. Anthem was a new option that was contracted by the city that took over, if I'm mistaken, Cheryl, just correct me, but I took over, migrated the Sutter and Blue Cross members to the new Anthem healthcare, I believe. If I'm mistaken, you can correct me when you come in the front. Yeah, thank you. But there have been some challenges working with Anthem, and so just wanted to let you know, and especially for those trustees that are retirees, in case they're getting calls from the retirees. So there's a few issues happening, and in some situations, some members may have not done enough of the homework to migrate to that system, and unfortunately, in those situations, they will probably have to wait for a particular qualifying event to make any changes. And what I'm getting at is they may have just done the change without not realizing that the doctors were not part of the network and everything else. But there have been situations where retirees have done their homework and they just were either given incorrect information by Anthem, or Anthem did not do a good job during the process of enrolling them, and so they were either left out, or Anthem told them the physicians were part of the network, but they were not, and so those we are working with in conjunction with HR at the city and in conjunction with Anthem. In fact, we have a meeting scheduled for Monday that is going to include HR personnel for the city, because as you know, the contract is actually with the city. We are not party to the contract signatures, so there might be situations where it may be easier for the city to address because they are the one that actually have the contract with Anthem. But there's also going to be representative from Anthem at that meeting. Suffice to say, my point here to you is there have been some challenges. We have some retirees that are not happy about it, and I wanted you to hear from me first. If you encounter a question from a retiree, please send it our way, and we will try to manage this as efficiently, as quickly as possible. We are working with the city, and I will keep you posted anything that comes out of that. So those are my comments. I'm happy to entertain any questions. And then because Cheryl cannot wait to come before you to give you an update on the CalPERS Defined Benefit Plan, I'll turn it over to Cheryl for that update.
Thank you, Roberto. And you were correct. The city has migrated from Sutter to the new Anthem provider for healthcare insurance for our actives and for our retirees. So thank you for that update. As many of you know, we are trying to get our investment professional staff into the CalPERS Defined Benefit Plan, and I'm happy to report that there was some movement. So we are now in our account management phase. There are going to be some specific steps that CalPERS is going to ask us to do with relation to City Council passing a resolution in order to amend that contract. And they have let me know that that process will take about 3 to 4 months to get everything through. But we at least got an update, and we're pushing through to get that done as quickly as possible.
So after the 3 or 4 months, then it's done? Or
Then
is
they
there
will-
another phase?
According to the people I've talked with at CalPERS, that's when we will begin enrolling our investment professional staff
Okay.
into the CalPERS Defined Benefit Plan.
Cheryl, why 3 to 4 months?
I asked that same question of the representatives, and I believe it's just through their process that all of these things need to be done in an exact order, and that's typically how long it's taken with other agencies trying to go through that contract amendment process.
So if I can summarize what you said, it will be sometime in May and June where our investment professionals be able to join the CalPERS Defined Benefit Plan. I mean, counting 3 or 4 months, we're expecting that.
Yes, and we'll be working to make sure it's done as quickly as possible.
Understood. I may reach out to them myself. I'm not sure that I can do anything, but because we have contacts at CalPERS. CalPERS is big, so we'll see how quickly they can move. But thank you for the update. I appreciate it, Cheryl.
Absolutely, thank you so much.
Thanks, Cheryl.
I do have a
Oh, go ahead.
question administratively for those investment professionals that are currently deferring funds into a 401K type of plan, and now they've done that halfway through the year. How does this impact those contributions?
My understanding, I will speak to it, but you can correct me. My understanding is that when they migrate to the new defined benefit plan, they will stop making contributions to the 401A, which is the tier 3, and then we'll start making contributions to the defined benefit plan. And then that 401A balance will just remain there. I suspect that they have the ability to keep it there or move it to any other place if they want to, but they will no longer be making contributions to the tier 3. They will only be making contributions to the new defined benefit plan. That's the 401A, which is a tier 3. That is not the 457, which are voluntary contributions. They can continue making contributions to the 457, which is a voluntary contribution. Did I explain that correctly?
Absolutely.
Thank you.
Thank you so much.
Thank you. All right, and you, done with is that all for your update, Roberto?
Yes.
Okay, perfect.
If I'm happy to answer
No.
any questions if you have.
Yeah.
Through the
Any-
chair, I think that newsletter will be helpful to the retirees and present members when you talk about the same issue. And I'm sure the phone calls will come in by then.
Yeah. Good point, thank you. All right, if there's no other questions, we'll go ahead and move to 4B, oral update from City Council. Pam Foley, welcome, good morning.
Thanks. Good morning. Moving quickly through your agenda. Just a couple of things. We're in priority setting session now at City Hall. The priorities, each council member comes up with a list of things that they want the staff to investigate and actually other council members to vote on as whether these are priorities for the city of things that we should be pursuing at a policy level. So if you have anything that you can think of you might like me to consider authoring as a priority, please let me know. We must submit it to City Council by by next Friday at 5 o'clock. So any research we will need to do in any items, please let me know, and I'm happy to bring something forward. So that's step one, is priority setting. Then we move into budget session in March, and the mayor will deliver his budget message, and we will all then, as city council people, determine how we may want to spend our essential services budget, in which case we reach out to our constituents, poll them, see what their priorities are, and make a pitch to the mayor on how we're going to spend our allocation, and the mayor says yes or no. So at my district, we actually are already surveying our community. If you're in District 9 or would like to see my newsletter, I'd be happy to send it to you. And we have a little survey that prioritizes, it's kind of a drop-down survey, which of these things are most important to you, and if so, where? And high on the list is typically public safety is one of the number one things in District 9 and actually across the city that's a huge issue and a major concern. So I'll be looking probably for my budget to fund more traffic calming, pedestrian safety issues in District 9. So that's where we are right now, priority setting. If you have anything, I'm happy to bring it forward or happy to chat about it. And then budget. And that's it.
All right, thank you very much. All right, let's move on to 4E, Public Employee Pension Funding Challenges, presentation by council. This request came from Mr. Santos a few months ago. He's welcome to frame the conversation or have some thoughts before Harvey starts, or?
Well, as a comment for the Valley Water District employees and unions, I requested this. It's for education. Even though we have a 4-year contract, I said, you know, being on the retirement board and being an employee, I learned that if you don't plan for retirement and the challenges that come up now, you're gonna be hurting later. And so Harvey accepted that invitation, and I can tell you, it was a 4-star job, and everybody walked away. Not any kind of controversy, just learning more about their responsibilities and what it takes to negotiate. And so I sure appreciate it. So thank you.
No, thank you.
Now, when Mr. Santos says everybody walked away, it was after I finished. Thanks, Dick. Good morning to everyone. This is much similar to the presentation I made to the Santa Clara Valley Water District, just to kind of give a background, and I think might be useful for us because we do get in the weeds quite a bit on our job here around the dais every month we meet, but this is kind of stepping back a little bit and talking about funding challenges. I'm very sensitive to funding challenges for pension funds. I chair the a working group and funding challenges for the National Public Pension Attorneys Organization, and we meet twice a year nationally. And we put on a panel about various funding challenges and how states and municipalities around the country are dealing with those. So I spend a lot of time evaluating creative ideas for funding that are coming out from around the country, and so I want to talk about some of those as well. Linda, if you'll hit the next slide. You've seen this, Bill's still here. This is our classic pot that has to be filled, and we've talked about this, multiple times in terms of just, as trustees of a pension fund, public employee pension fund, these are the valves that we get. This is the authority. Drew likes to talk about the valves that we can turn, and there are 5 of them. You've got employer and employee contributions coming in. Investment earnings coming in to fill the obligations in the pension fund, the liquid in the pot, and benefits going out and expenses, and these are kind of the size of those pipes are kind of in scale, especially in a system such as this where we're in a negative cash flow or very close to negative cash flow for the pension fund, meaning that the benefits and expenses running out of the red pipes are more than what's coming in contributions from the blue pipes, and we have to fill that deficit up with investment earnings. So the pressure, as you know only too well, the pressure's on all of our pension funds to increase investments. With those 5 valves, plan sponsors and trustees, states, municipalities, their pension funds all across the country have turned every single one of them in the last 10 years. On contributions, Lord knows we've reduced assumed rates of return, which brings in more contributions up front over time. We've reduced amortization schedules from 30 years to 25 to 20 to 17 to try to bring more funding in a timely manner. As Bill mentioned a little bit ago, we've updated the mortality tables to reflect that people are living longer in retirement. States and municipalities have issued pension obligation bonds. They've raised additional taxes. Some municipalities have sold assets, parks and buildings to be able to fund their contributions. On the investment side, that valve has been turned with allocations into riskier assets. And then on the other hand, there's been a big push to dampen volatility. So sometimes the valves turn to the right, sometimes to the left. Benefits have been all over the map. Here in San Jose, we have Tier 2. Most places did across the state of California, for example. We adopted PEPRA in 2012, starting 2013, which was a whole different benefit structure, a lower benefit structure, a higher age for vesting and drawing higher contributions. Tier 2, here, for example, we have the first time that employees are paying part of the unfunded liability as well. So that valve has been turned rather extensively nationwide. And then there's been a lot of pressure on the expenses pipe coming out in terms of trying to reduce the cost of administering the pension fund. A lot of states have been consolidating their, pension funds. Illinois is a perfect example. Illinois has dozens of local municipal police and fire, sometimes just police, sometimes just fire, and civilian funds. Pennsylvania is the same way. And in an attempt to reduce or appear to reduce administrative expenses, they've been consolidating those plans. Let's go to the next slide, Linda, and just we'll go through these quickly, just to give you an idea what's gone on around the country since the Great Recession. The so-called pension reform has hit just about every state. You can see here the velocity of pension reform legislation that's passed in the various states over the years. It took 2 years after the Great Recession really hit in 2009 for most of the states to adopt changes in all of these, whether it's on the funding side or the benefit side. And then a lot of other states have fallen into place with that as well. Here's a map of, just to give you an idea of how prevalent it is. This slide is the states that increased their employee contribution rates in the 10 years but after the Great Recession. And the next slide shows you the states that literally reduced their benefits to new members during that same period of time. Next slide, 31 states went after the funding challenge by reducing COLAs. COLA, is Bill still here? We didn't drive you out. As Bill will tell you, increasingly so with improved mortality rates, cost of living increases that many states and municipalities locked in at a set rate proved to be a very, very costly unfunded liability because inflation over the last several years has fallen below the locked-in rate. There are a lot of municipalities and states that find that their storage is almost full. What was that? That was just a prompt. See what happens if you use this as a teleprompter? Yeah, they had full storage capacity. So anyway, COLA's really, a number of states, Arizona, for example, and they started in 2010, when inflation was running, 1.5%, Arizona just froze COLAs for 5 years and literally fully funded their pension van based on that. And they did it at a time when inflation was low for that entire period of time. And so the pain that was suffered by retirees was much less than it would be in other times that did that. But most states cobbled together a whole different kind of approaches. New Mexico, for example, today is still considering tying cost of living increases over about 1.5% to the funded status of the plan. So that if the funded status gets up to like 80%, and they're a long way from that, but if they get up to 80%, then they will release more funds for the purpose of paying COLAs. That's in the New Mexico legislature right now. There were a lot of lawsuits that were filed across various states by retirees, of course, because they're counting on those promised COLAs to pay their retirements and even if it's not a designated OPEB fund, they need the money to pay increased medical expenses. Most of the states where litigation sprung up, the courts upheld the change under state law to the COLAs that were adopted.
And why is that hard?
Well, because in many other states other than California, these were seen, and it hasn't been tested in California, but they were seen as that the legislature never relinquished the authority to change these things. They were not vested rights. They were not promised to be locked in forever, even after retirement. Now, that's quite different than our understanding of California law, and I want to get to that. And once you retire in California, the law has always been, perhaps only up until this year, and I'll get to that, that you can't change the benefit after someone's actually retired. But it all depends on the language. And in many jurisdictions, the cost of living increases were not written as ironclad promises.
And that was probably deliberately, right?
Correct, yeah. And in some laws, they actually say this is not creating a vested right. Those COLA reductions across the country produce the largest cost savings and reduction of unfunded liabilities of any one of those valves that anybody could turn, simply because the magnitude of COLAs after a number of years, if you're paying a fixed 3% COLA, for example, and it's compounding every year, you can see it doesn't take more than, 20 years to double your retirement benefit.
In your philosophical, sort of mathematical understanding of this, Harvey, is that symmetric? Would you then therefore sort of say, it's probably true that a lot of reason why a lot of these plans are underfunded was because of the COLAs?
Well, it's true. If you wanted to separate out one element of the benefit, it was the COLA that was forcing it, because the money simply wasn't put aside for it. Now, as Bill will tell us, and welcome Bill to come up if you want, where there was a locked COLA, a fixed COLA, the actuaries anticipated that and funded it. But that's not the case everywhere. And in states and jurisdictions where the COLA was discretionary, they were not taken into account fully by the actuaries in projecting the contributions necessary to pay for them. Here I want to insert something that's not on a slide because, as I say, as part of my work in running the National Funding Challenges group for the pension attorneys, I've done some further research of some current things, and I wanted to bring this to your attention. This is, Dick, since I talked to the Water District in November, I've put some interesting things together just to give you some idea of what creative thinking is. I don't know how creative it is, maybe desperate thinking that's going on across the country. Arizona, for example, has imposed a tax on home fire insurance policies for residents that will then be a dedicated revenue source to go in to pay for firefighters' pensions. First time I've seen that anywhere. That's in Arizona.
Is insurance mandatory in Arizona?
I don't know if it's mandatory, but if you have a homeowner, a fire policy, they're imposing a surcharge that is then dedicated for fire prevention. Kind of interesting idea.
Did they seek the voters' approval on that?
That was, yes, voters did approve that. In Jacksonville, Florida, a half-cent sales tax. Adding a sales tax kicker is not that unusual, but that was also approved by the voters. In Illinois, they put a surcharge on 911 phone calls. So think twice about making an emergency phone call. I don't know how that works exactly, but that's to fund the city laborers pension fund in Chicago. Chicago also approved an increase to water and sewage fees, again, to create a dedicated revenue stream to go into funding the pension fund's unfunded liabilities. Kansas, a share of state gaming revenues. Kansas, you mean Missouri or Kansas?
Yeah.
Okay. State of Kansas.
State of Kansas.
State of Kansas, not a state of confusion. State of Kansas imposed a fee on gaming revenues for casinos, dedicated revenue stream for casinos. Louisiana put a tax on mineral and corporate tax revenues, mineral extraction, corporate tax revenues, sales taxes. Montana put a surcharge on coal extractions to help. Again, a dedicated revenue stream for their pension fund. In Nebraska, the city of Omaha approved a dining tax. Like we have the 4% for health care for employees, a dining tax. Now, I don't know. I don't personally think when I think of Nebraska about dining, but what the heck. New Jersey transferred the state lottery to the pension fund as an asset. Think about that.
Bada bing, bada boom.
Okay. Talk about going to gambling. Oklahoma put a 5% tax on net lottery proceeds and cigarette taxes. So you see, and the latest, which is really creating, and my panel this year is going to deal with this, in some jurisdictions where cannabis has now been approved for sale, everybody's looking to cannabis sales as the holy grail, the pot from which we can do all sorts of things in balancing the budget.
We see what you did there.
Yeah, I know. But that raises all kind of things, because even though the states themselves have legalized cannabis, the feds haven't yet. And this being a federal tax qualified plan, there's some federal tax issues relating to whether or not we could be funded by cannabis sales. Finally, the last one I have here is that the city of Pittsburgh put a charge on parking lots. Again, trying to create a less painful way of looking for revenue sources to solve the funding problem, so that you don't have these issues like Council Member Foley is facing with what are the priorities of my district. And I bet nobody says funding the pension fund in that. We're way down behind potholes and traffic, what did you call it, traffic calming? I like that. Traffic's very calm out there, it's not moving. That's how calm it is. The next slide is, are all these things helping? No, go back one, Linda. Thank you. It's hard to say. What I find looking around the country is that everybody seems terribly stuck. Most funds seem just stuck stubbornly on about 70% funded status, despite the outsized gains that we've had in the market since the Great Recession. We just, a combination of a lot of factors, we just can't get these funds passed. You look at most of the funds and they're all built up. Isn't that your experience as well? Yeah. Well, assumption changes are those things that try to get you closer to reality, right? So the closer we try to estimate reality, the more we're hovering around the 70% funded status, sometimes less, sometimes more. But even with all these so-called reforms and revenue changes and benefit reductions and new tiers, and it just seems to be an enormous challenge that our plans are facing.
What would that curve have looked like, Harvey, when you started your career, or 20, 30 years ago?
Well, that's the next slide, which is your favorite one.
Yeah.
And that's, if you click on that, you remember this. Vince, wasn't this your slide? Whose slide was this? For the city council, Prabhu's? Yeah, I'm gonna give credit to all of you, actually.
But you know, Harvey,
till I get to the right person.
Harvey, the midpoint of that distribution was never 100%. It was always less than that, right?
Well, it got to 100%, but in the bubble. It got to 100% right before the dot-com bust. 1999, it got
But it always sort of bounced around as the economy came and went below 100%.
Yes.
Right? It was never like 110% for a decade,
Correct.
right? Yeah.
Correct.
Yeah, okay.
Yeah, exactly. But it really is, it's the yield curve. It's, you know, that, and if you can click on that, Linda, yeah, click the slide, and it'll start that in motion. Maybe it didn't.
You mean if you click the actual day, 1
There's a
June
video
1990?
underlaying that?
What's
Click
that?
the date.
Yeah, Jeff,
Click,
Well,
click the
okay,
thing.
so you probably have on a PDF, so don't worry about that. Let's go to the next one, because that's that's Bill's slide on declining interest rates, and that's really what's gone on. You know, in California, it wasn't until 1984 that our public employee pension funds were allowed to invest in the equity markets. Before 1984, we were clipping coupons, and that was it.
That's the ERISA Act, right?
No, this was Prop 21 in
No,
California.
ERISA in the federal.
The federal, yeah, in the late 70s.
Yeah.
But it wasn't until 1984 that our boards did anything other than essentially clip bond coupons. And the bond markets were producing 7, 8%, 9%, whatever that demonstrates. So, and you can see that. So after 1984, Prop 21 passed in the state of California and let boards invest in a broad, diversified portfolio, bought into modern portfolio theory, which I'm going to talk about in a minute. But for the last 20 years, interest rates have plummeted, and it's harder and harder, as Bill's slide here shows. The only way you can maintain that funded status is to try to make it up in the investment markets. And it hasn't happened. It's happened for a while, but it just hasn't borne out. If you'll flip to the next one, Linda. So you recognize this. This is the so-called efficient frontier. This is the theory over time of risk and return. Return goes up when you go further out on the risk yield curve. This, by the way, is written into the state constitution. Your obligation, one of your obligations under the state constitution as pension trustees, is to broadly diversify the portfolio. They've bought into modern portfolio theory as a matter of constitutional guidance requirements of this board. And this is the idea, this so-called efficient frontier, that you can count on over time returns reflecting the risk that you're taking on. But if you look at the next slide, you've seen this from a lot of different sources as well. This one I took from the folks at Callan. Whoops, too far. Back one. There we go. This is the periodic chart of how each sector, I don't know if you can see, this might be too difficult, but you know, this is how each asset allocation disappears from the face of the earth. That's good. Cool. These are not Iowa ballots, I want you to know. This is not an app. It's not supposed to be anyway. Let's try that again. When we get back to the reality of risk and return, now I know we're not looking at a 30-year. We're only looking at 20 years here. There we go. Let's pop that up. I think it's like 12. You can see it down on the bottom there. There it is. It is 12. Yeah. So you look at each segment of an asset allocation, for example. Take real estate. I don't have a pointer here, but take a look back in 2000, and follow along. The real estate is that blue square, 2 in from the upper left. And then look where real estate performs over time. Now, real estate is supposed to be a relatively low risk, medium return asset on the efficient frontier. But it just bounces all over. Over 20 years, it's up and down and around. You can look at the same thing, look at emerging markets. In fact, just look at the last 2 years of emerging markets to the far right. Emerging markets in 2017 on this chart was the best performing asset class. The next year, 2018, it was the worst. Now, over 30, 40 years, maybe it performs the way it's supposed to, and you're supposed to be able to anticipate it on the efficient frontier. But despite the fact that we say we invest for the long term, we don't invest in all these things for the long term. We change our allocation over time. We try to react to markets. So while they may, in theory, even out along that efficient frontier, counting on investment returns to fully fund the system is probably chasing a phantom. That's the challenge of funding these plans. The other thing I want to leave you with, because it's really timely now, and it's the last slide here, is there's another curveball lurking out there, and that is the vested rights litigation. We haven't talked about that since that Cal Fire case came down last year. That's the first one on this list. I put this list together. These are the California vested rights cases that are presently pending before the state Supreme Court. They've been pending for 2, 3, sometimes 4 years now. And the Cal Fire case got heard last March, only because Governor Brown was on his way out, and he pressed the Chief Justice to schedule it for argument and a decision. And it did come down, and that was that airtime case for firefighters, state firefighters, CDF, California Department of Forestry, right? Forestry or firefighting? Forestry. Airtime was the right to buy 5 years of additional service credit granted to firefighters in the state level. And PEPRA came in, the pension reform in 2013, and said, we're not doing that anymore. Even for legacy members, not just for new members of the system, but for legacy firefighters. So if you had already been a CDF firefighter, anticipating that you could buy 5 years of additional service credit, which would increase your pension fund, your pension payments, that was taken away by the state legislature. They sued. They said that was a vested right. That was a promise you made to us, and you can't take that away without violating our contractual rights. California Supreme Court disagreed. California Supreme Court said that was never a right that the legislature intended. It would never change. It was and you can't limit the right of the legislature to make changes in the law as it needs to react to current situations, economic situations. It didn't get to the vested rights rule, the so-called California rule, because having found that the members did not have a vested right, you didn't have to get to that point, well, if it is a vested right and you take it away, do you have to give something in return? They didn't get to that point. They simply said, it's not a vested right, we're gonna punt. Stacked up behind the Cal Fire case are all these other cases, the Alameda, Contra Costa, and Merced case. I'm counsel of record to both Alameda and Contra Costa retirement funds in those cases. We are next up. We've been sitting in the Supreme Court's queue for 3 years now. This case started, my first hearing in this case was in May of, the first hearing in this case was 2012. November of 2012. So we're now pushing 8 years. We haven't got argument. 2 weeks ago, the California Supreme Court sent us a notice saying they were going to schedule argument in the case. So it's the next one up. They're gonna, it won't be April, somebody already nixed April, so it'll be March or May most likely. And it'll be the first case that will absolutely tee up the so-called California rule as to whether or not, if it is a vested right. In this case, the things that were being, the pension funds were counting in a member's retirement benefits, terminal leave cash outs, a year's worth of terminal leave cash outs, so they built leave on their balances. They had banks of leave. For many members, standby and on-call pay was being treated as pensionable. So people's benefits are at risk. Legacy members' benefits are at risk in this case because the court could say you never had a right to have those things counted in your final pension, so your pension's going to be $8,500 a year instead of $9,500.
Are you actually going to argue that? Are you going to be one of the lawyers arguing the case, Harvey?
Yes. Yeah.
Let us know. Is it up Sacramento?
It'll be in San Francisco.
No, Sam? Love to attend. We let the board know when that happens.
Yeah,
It'd be really interesting to
absolutely.
go,
Now, my role, just to digress for a moment, is the boards I represent, Alameda and Contra Costa County, had treated certain items as pensionable before the law passed, but then the law changed it. And I advised those boards, it's all public, to follow the law. They had no obligation to follow the law. And they did, and they got sued.
Right.
And they got swept into this vested rights argument. The pension boards I represent take no position as to whether members have a vested right or not. That's not their role.
Right.
Their role is to say, you tell me what the plan is, and we'll administer the plan. That's what a trustee does. It's not to say the plan is right, is wrong. That's between the plan sponsors and the employees to figure out whose rights are what. So my argument, to get to the point, is probably going to be 5 minutes.
Yeah.
Because the role I'm playing is simply to say, my pension boards did the right thing. They followed the law. You shouldn't impose any obligations on the pension boards. But the big argument is going to be between the state of California and and some of the districts, employer districts, and the unions and the employees who are arguing that their rights have been altered. There's a Marin case that's pending at the same time. They haven't even asked for briefing in that case. So that's just sitting out there. Behind that is the McGlynn case, which are a bunch of judges who claim that their rights were violated by the new law. And behind that, the Hipsher and the Wilmot cases. These are two, turns out to be firefighters, Andrew, sorry. These are two firefighters who were convicted felons. And the law changed under PEPRA and said that if you commit a felony, if you're convicted of a felony for acts done while you're in service, the period over which you committed those felonies gets jettisoned from your service time that's counted towards your pension benefit. So it's a felony forfeiture statute. And these two fine, upstanding gentlemen argued that they had a vested right not to be subject to forfeiture of their benefits because of their felonies. And the Supreme Court has accepted review in those two cases as well on the vested rights question, but they haven't caused for briefing. They just took all these other cases than the Alameda case. We're fully briefed in the Alameda case, and they put the rest of them stacked up like planes over United Terminal O'Hare and said, you just keep flying around in a circle till we decide the Alameda case.
Which is actually reasonable, right? Because they're all related.
Sure. I mean, there's no sense bringing those in for a briefing on vested rights. The reason I put this in front of you is the Supreme Court, to take this back to a funding issue for our pension funds, if the Supreme Court were to vote that these were not vested rights, or if they were vested rights and you took them away, that you had to give something of value in return, If the Supreme Court rules against the members and employees in these cases, it's going to have a material effect on the funding of the pension funds that are subject to these rules, all up and down the state of California. What that effect is going to be is hard to say because the court could fashion any number of different things. One of the other cases we have stacked up behind the Alameda case, but it's in Contra Costa County, is this, and I was talking to Franco about it this morning. If the Supreme Court says you folks in Contra Costa County thought all these things should be added to your pension when it's calculated as a vested right, and we tell you that it's not a vested right, then the members are going to come in and say, well, you took contributions out from our pocket to support that benefit. And if you're saying we're no longer entitled to that benefit, contributions have to come back plus interest at the assumed rate of return for 10 years, 20 years, 30 years. So I can't really predict whether the actuarial liability is going to go up, down, sideways, or what. I don't know if Bill's ever run any scenarios on that. No comment. But there's going to be an impact. Whichever the way the court rules, there will be an impact on the pension funds. Andrew?
I'll let Dick go first and all.
Just a question, just for your input. If the Supreme Court of California made some judgment, it affects them. Would it then be deemed unconstitutional for them to judge that and send it to the Supreme Court?
Do they have a conflict of interest?
Yes.
Yeah. Well, the judges in California are all members of the judges' retirement system. And interestingly, that McGlynn case is a class action brought by retired judges who retired before PEPRA. So that's been argued before. That was argued in our Orange County case about 8 years ago, that the bench, well, you know, the judges all had defined benefit pensions, and so they were all prejudiced and they shouldn't hear the case. And the judges just said, no, go away. We're going to hear this case. It hasn't been filed in federal court yet. The constitutional protection against impairment of contracts, where this all comes from, is in both the California Constitution and in the federal Constitution. Nothing to say there couldn't be a federal challenge under federal Constitution as well. Unlikely, I think, at this stage. This has gone on too long. Since these cases were initiated, 10 years have passed. People have retired, they've been paid what they've been paid. It's going to be hard to see anybody, even the unions, taking on, initiating a federal court claim at this point.
But what I see is that they say, well, the present retirees will stay, but all new.
Well, new people came in, just like in Tier
After
2.
PEP-
They were told what when they came into employment, this was the new promise. And so they're not going to be able to claim what legacy members had. I put in the end, the last two slides in the deck, just so you see, this is some survey data. It goes back 2 years, came from Chiron, thank you. And Bill has presented this before, but it just sort of shows, you can see in the first column, about 6, 7 down, the city of San Jose is federated in police and fire. And just kind of gives you some relative statistics on other funds and their funding status, their contributions. Interesting, the last one, which is slide 23. It's a pretty interesting indication that almost every system in the state of California is in negative cash flow at this point. It's what Bill and the actuarial community like to call mature plans. So look at the data, they're all hovering at or below positive cash flow. So that's kind of an update on kind of a bird's eye view of everybody's, just so you know, you're in good company. You're in good company across the country. Everybody's been grappling with these things. And the last thing I'll put to you is a challenge, and that is, right now our tier twos do not have significant unfunded liability. And I challenge the board and the federated board to spend a little skull power on how can we keep from having to go through this again, what we've been going through with tier one at this point. We have a growing cadre of tier two employees, growing faster than I anticipated. It's 30 to 40% now of the workforce, tier two. And there's very little, if any, funded liability associated with it. If we could do anything to insulate that tier from having to go through this unfunded business again, like Groundhog Day, that would be a tremendous legacy this board could leave to the city of San Jose and to the employees who work here. So I throw down the gauntlet for some creative thinking in that regard. So, any other questions?
Thank you, Harvey. I think Vince had a question, and then I'll follow with a question.
If we went back to slide 3, Harvey, where you have listed all the different valves that the sponsor and trustees can impact, and you were to try and plot this in an effort to prioritize it, where you plotted it and said, okay, at the bottom of that chart that you're looking at are the hardest things to do, and they're the least impactful, so I'm not going to pay attention to that. And there are things that are easier to do and the most impactful to the plan. What would flow into those two different areas? So we could think about, particularly in the retirement service, the Retirement Solutions Working Group that's been established, maybe they start talking about those things.
That's an interesting concept.
And I know I'm putting you on the spot, and there's 14
Well,
different things up here.
You know,
but-
I think we can make some, this is like refrigerator magnets, I can
Right.
move them around. So in the lower left-hand quadrant
Correct.
of least impactful would be the last category there, expenses.
Okay.
As a percentage, an impact percentage of the system, that's gotta be the least impactful.
Mm-hmm.
And maybe one of the hardest to do, however, so I don't know where that, I gotta have to think about that. Because at some point, you can't materially get those expenses much lower. The most impactful, you just don't update your mortality tables. Right. Bill, why don't you come up? Come on. Come on, I don't want to do this alone. Because, you know, yeah, you could hide from reality. You could pretend people aren't living longer, you know, but what does that get you? That's fake news. That's fake news, yeah.
The most impactful things are the hardest to do. Unfortunately,
It's the
that's,
benefit
it's the
reductions.
benefit changes. The investment stuff can be very impactful, but you don't have a whole lot of control over what the markets return.
So what you're saying makes total sense, but I'm wondering what might flow to an area that is somewhat doable and can be very impactful on this list.
Well, I do think over time, the contributions are impactful, but they're a very slow moving fix. And when you first start, it could be easy, but as you raise that contribution level, it gets harder and harder. And so my sense is we've kind of push that lever about as far as we can. Some of this is just gonna take time for these large pension systems to recover. And I think in a lot of cases, that's what we're seeing now, is systems have made adjustments, they're on track. But it's gonna take 10 to 20 years before they're really significantly improved. In other cases, they haven't made the changes yet.
And the projections, you know, the projections that are made all assume no volatility. And it's the volatility that kills you. So this is why you get paid the big bucks, Vince. There's no easy solution to, you know, what's developed as an unfunded liability. You know, a number of people have thought that floating POBs and playing that arbitrage game between interest rates was the way to go. And it worked for some, it didn't work for others. It's just a timing issue. If you play the market right, it works. If you get it wrong, through no fault of your own, you lose the arbitrage, and it doesn't work. So that's kind of a gambling way out. As I say, you know, reducing COLAs was painful, but in many jurisdictions, reducing COLAs was sort of the difficult choice for retirees to preserve at least the corpus of their benefit and hope that inflation didn't eat it away. There are ways that a number of states and municipalities adjusted the COLAs to maintain a certain level of purchasing power, so that if the inflation made the value of your benefit lose more than 15 or 20% of its purchasing power, there'd be a governor that gets you back up to 70, 80% purchasing power. That was clearly, the reduction in COLAs was clearly the biggest impact nationwide to help true up the funding of the systems. But it comes at the pain of people who don't have a seat at the table. Whereas benefit changes are bargained for, and, you know, the case has to be made.
State level basis, it might not be bargained.
It might not be, some states not bargained for. But in California, you know, it's subject to the collective bargaining, and, you know, those are different.
But now, don't those COLAs, that's affected more by people that are related to CPI, where they're fluctuating consistently? What about someone that has a stationary COLA? Because ours is a stationary fixed rate, correct?
For tier one.
Yeah, for tier one.
For tier
It's
one.
not fluctuating, so we're paying what the COLA costs.
So, but we're pre-funding the COLA, right? But these changes, in a lot of cases, they were pre-funding the COLA, but then 2009 happened, and so they just reduced the COLA. So it would be comparable to just saying, okay, we're gonna change your 3% to 2% or 1%, or suspend it for 4 years. That saves a lot of money. But you know where that money came from. They were just finding ways that in their state, the COLA was not part of the vested right of the benefit. And so they were just looking, in my opinion, for any benefit they could change that was not covered by that contract interpretation in their state. And the
But-
COLA was the big piece they found in a lot of states.
But the scale of that is staggering, right? We have a fixed COLA of 3%, right? The average inflation rate over the last 14 years is 2.1%. So that means we've been giving, it's a contractual right, we've been giving 1% every year. And in the time you and I have been here, Vince, have we even lowered the discount rate yet over 8 or 9 years by a full percent? What was it, 7.75 when we showed up?
It was 8.
It was 8. So we've just now, over 8 or 9 years, lowered our discount rate by 1%. You could argue that all we did over 8 years was simply just inflation in the COLA. And we haven't even caught up quite to that yet. And which is what you're saying, right, Harvey? This is of a magnitude that, it's the old chess, you know, to double the pennies on every chess piece, and pretty soon you got a stack of pennies reaches to the sun.
One of the biggest factors that's going to be to change the pension landscape in California is going to be, of course, the court cases. With the Cal Fire court case, it sounded like the Supreme Court had the opportunity to address the California rule. They didn't. But in the Alameda case that's coming up, is there any chance that they could avoid not addressing the California rule and kick it down the road even more?
No.
Okay.
No, unless they send the case, which they'll do in either event, but they could send the case back to the trial court for additional findings. The Intermediate Court of Appeal said the trial court should go back and consider the actual impact in each county of granting or not granting the increases. That's, in my opinion, nuts.
Yeah.
And that would prolong it for another 20 years. But, so the Supreme Court could do something like that. But the issue of whether or not the calculation of the core benefit is a vested right or not, because the boards had calculated in a certain way, including leave and standby pay and that sort of thing, for a long, long time. And it was even approved in a court-approved settlement agreement from the old Ventura case, you may remember, from 1997, which we've been litigating over for the last 20 years. The way these boards were calculating final compensation to pay the benefit on was approved by the court then. And so there's no question that whether or not that was a vested right is first and foremost before the court this time around. I don't see them dodging that issue, but it's going to be momentous.
Yeah.
And they could just say, you know, it wasn't, but now you got to go back and have more findings or something like that.
Either way, we'll know something towards the end of the year.
We'll know something probably by the third quarter of the year. If the decision in CAL FIRE is any indication, every one of these new justices, and they're almost all new on this California Supreme Court, comes at it a very different approach. They all have very different backgrounds. And not all of them were judges before. And CAL FIRE was the only case they've really ruled on a pension benefit. So it's a big learning curve for them.
Yeah, thank you. Dick?
I know Frank was part of the group that determined this last time we had Measure B for the retirees for the COLA. It's my understanding that the city council can take that or reduce it only in cases of emergency. Is that correct? For Tier 1.
For Tier 1? No, I don't know that there's an emergency
Or Tier
exception.
2, whatever.
They saw
Bank-
one, but that
bankruptcy.
wasn't, yes.
I mean, bankruptcy would change those retired members' benefits potentially.
Bankruptcy, all rules are
Yeah.
off, you know.
If that's what you're referring to as an emergency, it would be bankruptcy.
That would be it? Okay. No
But
other-
but it's
no
not
other
a self-declared insolvency or service insolvency or anything like that. That would excuse it.
Mr. Chair, just one last comment, because I wanted to address an issue that was raised by council, and I want to publicly indicate that this board has thought about it, and specifically Federated have actually have retreats to deal with that issue. I just didn't want to lose the opportunity to mention that publicly in regards to Tier 2. So your point is well taken, but this board has thought about it, and Federated specifically, because they're further ahead on that issue, they actually have discussions in 2 separate retreats, and so they're well aware of it. And I don't want to put words in Chiron's mouth, but it appears to me that they agree this is something that had to be tackled, but that there's still some time. I guess I just want to make the point that, yes, both boards are well aware. One of them that is further down the road because there's a much larger tier 2 population have been dealing with it, but there's still some time before any final decisions need to be made. But suffice to say that they are certainly keeping abreast on what the challenges are, so that when and if needed, they can make the decisions to make sure that both tier 2 is not impacting in a way that it has an increase or large unfunded liability.
One last, just to follow up, and I guess to the question of worrying about the future, and tier 1 I think is a different animal from a different time, but considering tier 2's growth and how fast it's growing, and I agree, I think, what are we approaching 50%?
45 to 85 right now.
Yeah, 45, 55% for tier 2. So it's grown very, very fast in police.
Not quite that way in fire.
Yeah, so in police, just because of our hiring. Yes. Because of restrictions in benefit increases, because of who pays the funding ratios, obviously they're more split. Wouldn't you say that they're just by nature going to be a lot more stable?
I'm going to make one comment. I'll let Bill be the one who offers the real facts. I would, except if we have a market correction of 20%, forget about it.
Yeah.
If we have a market correction of 20% tomorrow, tier 2 is not a big deal. Tier 1's a huge deal.
Yeah.
Tier 2 will be stable for quite some time because it is a young and growing system, and so the growth can compensate for bumps you hit in the road along the way. But what you need is a plan to deal with when all the current tier 2 members are retired. And so it's planning now for that eventuality, which what we've talked about as a possibility in Federated is that you set a higher target of assets to accumulate for them at the time of retirement, so that when they retire, you could invest much more conservatively and not have the volatility.
So, and that's kind of what I was going to follow up with. So that even when the first tier 2 start to retire, that same 20% correction wouldn't be that huge of an issue. Now, one factor that I see in it, and I don't see you have it up there, is growth or lack of growth. Because part of the reason that this system is so risky is because we've got more people collecting than we have paying. So if these systems don't grow, or they don't even maintain, a certain level and shrink, technology comes in and, changes public safety, and you can cut these workforces in half, we got a problem. Yep. Just the same as if they cured cancer tomorrow, we got a problem.
So we definitely have problems if we don't have jobs for people, right? But that's a different problem than the pension problem. We tie things to payroll a lot, but you need to think of it in terms of the revenue from the city. And so if you could suddenly automate your police force and not have any officers, as long as the revenue was still coming into the city, we'd have a resource to use to pay the pension benefits that had been promised for the retirees. So it's really what happens to that revenue source that is absolutely critical. And so if you look at the cases of bankruptcies and really bad situations, there is always a revenue story to that. People will focus on the pension, but it's what happened to the revenue of the sponsor that really caused the fundamental problem there. If the revenue of the sponsor just keeps growing, you can get out of most situations, right? A significant part of our payment as a percent of pay is for the unfunded liability. But if you doubled the revenue and hence doubled the city's workforce, that percent of pay would drop in half, right? So it ends up being a much smaller share of that much larger pie. The places where it's really a problem is where that pie shrinks and becomes smaller, and we're still demanding that chunk. And so that gets to be a bigger and bigger piece of their revenue. And, you know, so locally, if you looked at like Stockton, they had, in the housing bubble, their revenue went way up, and then the bus, their revenue dropped through the floor. And that's when the problems occurred. You find that in some of the bankruptcies in Alabama. Certainly Detroit was a much longer, slower decline in revenue. But these are long-term promises, and with the investments we're making, part of the deal is we're taking these investment risks to get a better return, but if those returns don't pan out, we're going back to the sponsor for the money. And so you have to have a viable sponsor, and if over that long horizon the sponsor declines, then you don't have that source. And so that is a very critical piece to watch and keep an eye on. And I think that is driving some of the discussions of, the solution is we need to expand a revenue base. And you can do that with new taxes, you can do it with growth, you can do it with a variety of things. But that is it's a piece that we don't focus on here as much because we're taking that as a given, and all our projections are based on kind of a status quo projection in terms of the size of the city and all of that. But it is a very critical piece.
Bill, you're talking about revenue for the city, and I'm assuming the revenue for the city is higher today than it was back in 2009. I don't know if that's a fact, but I believe it is.
Yes.
But I don't believe, the other part of the equation you're talking about is as a percentage of payroll. I don't believe the head count is larger today than it was in 2009. Maybe I'm wrong, but, so now I'm getting confused by when you talk
It
about it as a
is.
percentage of payroll versus the revenue side.
So, yeah. The really critical piece is the revenue side.
Okay.
We shortcut to pay because we're given pay in our data and can look at it. And for a lot of the other systems, the statewide systems, trying to figure out all the revenue that actually supports all the different employers in there is impossible. And so as an industry, we've just kind of shortcut to pay as a rough proxy to revenue. But revenue is really what drives the sustainability.
Got it, okay.
All right, thank you. That was a great,
Thank you.
that was a great presentation, great discussion. Dick, I appreciate you bringing this one forward.
Thank you for scheduling.
No, there's a lot of provoking conversation going on and gives a big picture perspective. So, but it sounds like there might be end of this year, third quarter, maybe fourth quarter, there'll be some movement one way or the other. So, we are probably about 10, 15 minutes away from finishing up, but there is a request to take a 5-minute break real quick. So, let's come back at 11:05. Thanks. Let's go ahead and get started here.
It's after 11. You're inside the zone. You're inside the zone.
You killed me there, taking a break. You killed me.
I know, I saw the text.
Okay, that makes sense.
All right. Thank you for accommodating that 5-minute break. On to, where are we? We are retirements, 5.1. Joseph Abasolo, fire engineer, fire department, effective January 31st, 2020, with 25.64 years of service. Robert V. Gutierrez, battalion chief, fire department, effective January 26, 2020, with 27.62 years of service. Richard J. Mizgorski III, police officer, police department, effective January 25th, 2020, with 24.77 years. Stephen D. Nelms, police officer, police department, effective January 31st, 2020, with 23.39 years of service. Elazar Zamora, fire engineer, fire department, effective January 31st, 2020, with 25.06 years of service. And then we got a couple deferred vested. Joseph H. Deres, police officer, police department, effective January 21st, 2020, with 27.58 years of service with reciprocity. You got Mary F. Gutierrez, battalion chief, fire department, effective January 26, 2020, with 24.93 years of service with reciprocity. Can I get a motion for?
Motion to approve.
Motion with, for Santos?
Second?
Second by Sinceri. All in favor? Aye. All right, we do have some death and survivorship notifications. Notification of the death of Eugene Adams, police officer, retired June 10th, 2000, died December 5th, 2019. Survivorships to benefits to Carol Adams, spouse. Notification of death of Donald Ewing, police lieutenant, retired September 11th, 1982, died November 18th, 2019. No survivorship benefits. Notification of death of John Nunez, police officer, retired November 20th, 1995, died November 11th, 2019. Survivorships benefits to Linda Nunez, spouse. Notification of death of Dalton Rollin, police sergeant, retired June 5th, 1993, died December 3rd, 2019. Survivorships benefits goes to Shirley Rollin, spouse. Can we take a moment for silence? Thanks. Thank you. Dick, Nick, do you guys know any of those people?
I know them all. Would just like to send our best wishes and our condolences to their family and friends. Gene and Don were both quiet guys, but both really good police officers, and a special thanks to Dalton Rowland, who years ago took a young detective under his wing and passed along some really good investigative advice and knowledge about how to do this job the right way. So very appreciate my time with all of these guys, and again, just our condolences to their family and friends. Thanks.
Thank you.
Thanks for their service.
Yeah, appreciate it. All right, on to committees. 7.1 Investment Committee. I know Oswald's not here.
This council that went in January.
What's that? Yeah. January was canceled, and so the next meeting is for investment's going to be March, and it sounds like there's a pretty big agenda for the March meeting. 7.2 Audit Risk, Vado.
Have not met since October, but I think we're meeting at the end of this month.
Yeah, next after the Fed board meeting in 2 weeks.
Okay. Governance. Nick, it doesn't look like there was a meeting.
No.
December 5th?
No.
Okay. We do have number B, 7.3B, discussion and action on government's committee's recommendation to deny purchase accessing to Chiron's educational tool for trustees' use. So to jog the memory, back in October timeframe, there was a request by trustee Oswald to have a discussion in regards to potentially purchasing an educational tool that they would build. That was November, went on the board agenda for November. It was missed labeled, so there was no, we had a discussion, but we weren't able to take action. So it got pushed out to December. There was a discussion for it to go to the Governments Committee for discussion. December's board meeting, I went to governance in December, I believe it was. 2 of the 3 board members were present. We'll let them speak to it. But it was brought back to the board. It was on our agenda it was in January. We deferred it. Not everybody was present, and so we deferred to this month. This is the dilemma I have. I got an email from trustee Oswald. He was planning to be here. He was sick, so he's not able to make it. One of the reasons we proposed it in January, because I wanted him to be involved in the discussion, since it was an item that, he brought forward and had some strong feelings about, and has some great arguments for accepting or to get the tool. Since he is not here, looking for guidance on the board here, there's basically 2 options we have. We could have discussion and hear from Franco and Nick in regards to how the conversation went from the, drawing a blank on your committee, your governance committee, and take a vote. Or we could defer this 1 more month, and I would want to set, if we do defer it, I'd want to set a hard deadline for that month to make a decision. Where do people stand on this?
Well, I'd be completely honest, I don't remember what I had for dinner last night.
Okay.
So to go back to what we were talking about in October and
Okay.
November.
Yeah.
I do kind of semi-remember, I think it was just me and Nick, and we were both not totally for it in the
Yeah.
first place and felt that it was kind of under represented
Yeah.
at the conversation. That's about what I remember.
I remember the same. It was basically being driven by the one board member, but in fairness to him.
Yeah.
I think it would be fair to defer it a month,
Yep.
hard cap.
Yep.
And give him an opportunity to come to the board and kind of make his pitch.
Yeah, and I agree with that. I would definitely want to hear it. He had some great arguments for it, and I definitely want to hear it. Even if we made a decision today, I think Chiron said they wouldn't be able to work on the project until closer to June timeframe anyways. So there is no urgency behind it. If there's any other thoughts or someone disagrees with not deferring it. Okay, so let's go ahead and defer that till next month. And we will definitely have that discussion. So appreciate it.
Let me ask a question.
Yes.
Frank, it was in March 4th, that's the meeting was selected for the governance next meeting? Because I've never been contacted, I just saw it here.
I'm not governance anymore, so
I'm sorry.
I'm,
The next
Audit.
meeting is on March 5th.
Yeah, I know, but who selected? I never got notified. I don't even know if I'm available.
Trustee Santos got, who selected the timeline? I believe what happened is when the year starts, Trustee Santos, staff put together the dates of the committees, and there are some committees that are scheduled to happen on a quarterly basis. And so when you board approved this, either was your December meeting or January meeting, you approve ahead of time quarterly meetings for governance, which is March, June, September, and December. Is that correct? And so that's where that came
Yeah,
from.
my interpretation is, well, no, let me go back. The reality of it is, I've always been called and said, can you make so-and-so? So this is the first time, I understand the scheduling
Yeah.
meetings, but usually find out ahead of time, can you make these certain meetings? Some of us have different calendars, and I don't have no idea.
All right.
We'll have, make sure staff reaches out to you and let you know when the meetings are, so you can put them on the calendar for the year.
Yep.
Does that work?
Thank you.
All right. All right, 7.4, Disability Committee. Any updates?
Update will meet on February the 19th. Our staff and our board members, committee members are doing a great job and looking forward to it. This is out of sync because of Dr. Chairman, some traveling or whatever have you. We
It's
always-
always a bit off in the
And we always
new year, so-
accommodate everybody.
Okay.
Thank you.
Great, thank you.
My point, staff calls me, says, can you make so-and-so? Yeah, if I can't, Drew says, yeah, and then we compromise and change when someone's the need. But usually it's always consistent. It's just unfortunate, the last couple of months, Dr. Chairman's been traveling, and it was, I think, an illness also.
Yeah,
So-
okay.
And then caseload.
Mm-hmm.
If it's one, they defer it, but if it causes someone some finances, of course, we change and go immediately to
Yeah.
help out. Yep,
Okay.
thanks.
Great, thank you. 7.5, JPC.
So we have been trying since October to schedule a meeting. We had to cancel December because there was no quorum. We had to actually cancel January because after we scheduled the meeting, we realized we were not going to have quorum. So now we send an invitation. It looks like we have enough members now to schedule the meeting for the last week in the February. Linda, we're going to be following up with the committee by tomorrow. And so it's one of those days, I'm not particularly sure which day, but it's in the last week. Our goal is to have full attendance because at your meeting, one of the things that your committee is going to be doing is selecting a chair and a vice chair. You are required by charter to select a chair and a vice chair on an annual basis. You currently have two. The chair is Vince from Police and Fire, and the vice chair is Anurag from Federated. The committee can certainly keep the two the same or change it, but that's one of the few items that the committee had to address, and we're hoping that we can actually schedule the meeting for the last week. We'll do that tomorrow, I guess. We're just waiting for one more member to let us know. Thank you.
All right, thank you. All right. That's it. So proposed agenda items for next month. Anybody have any? And what I'm thinking about that I want to throw on there is to start solicit ideas for an offsite agenda items. What kind of topics you guys want to discuss? The last several years has been, a lot of focus has been on the actuarial stuff, investment related. And so we'd like to see what you guys want to put on the plate and think is a priority for discussion for an offsite.
Would you like to make that an item for the next board meeting?
Yes, please.
Okay.
Yeah. Not yet. Not yet.
They're kind of all over the place,
But they
typically.
are they? I don't
Usually
remember,
May,
Linda. Are they
June.
usually in a regular board meeting day or separate?
Separate.
Separate. Okay.
It's usually May,
Just like to get
June.
these things on my calendar.
Yeah.
Yeah.
It's usually May, June, and then we'll try and solicit best dates or weeks, and then,
Okay, great.
We've had
Yeah.
them in the fall.
Thank you.
before. You can do whatever.
any public comments? None? All right, this meeting is adjourned. Next meeting is March 5th. Thanks, everybody.